Hello and welcome to Big Deal. I'm Nisha Poddar. Now, the equity markets in India have shown immense resilience despite the weak macro data globally and has opened a window of opportunity for many equity deals on the bourses. In fact, private equity-led block deals in particular have been the trend in recent times. But what does this really mean for the broader equity market deals, and are these sustainable levels? Let's find out from our team of experts joining us on the show, Vivek Gupta of KPMG India and Salil Pitale of Axis Capital. Thank you so much, gentlemen, for joining us. Now, both of you are deal makers, have the pulse of the markets. Salil, let me begin with you. What's your view on the deal street with this equity market window really presenting itself? Has this really infused confidence for more transactions while the deal flow has been on a slow lane?
No, I think so, Nisha. Markets, the deal street is coming off a few months, 7-8 months of very tough periods, wherein we would have seen that, there's been a lot of FIF capital flow out of the country. It's reversed in the last month or so. And the quality of the names that are coming in is also telling us that, it's some good quality set who are participating in the deal activity. The domestics have always been there, who held forth in this last 8 months when the FIs were in the sell mode. So I think both the fact that, foreign money and good long only quality money coming in, domestics holding forth, retail HNI looking stronger, means that I think deal activity, at least right now, is definitely there. It has to be carefully calibrated. It's not that every deal goes through. People are looking at valuations in the current context and not necessarily the euphoric valuations in some cases earlier on. But one would tend to believe that there is a fair amount of action on the ground. Yes. We as bankers are engaged with a lot of players right now to see which of them hit the markets. And you would have seen in the recent past, there's a fair amount of block deal activity. There's some activity on the QIP side. There have been 3-4 IPOs which have gone through. There's some of these stuff still lined up. So yes, we are quite enthused. We think this is a market window which is opened up. There would be some deal opportunities which will still go ahead.
That's right. For corporate finance, also for the companies, it is providing a lifeline in an interest rate hardening scenario. But Vivek, let me get you into the discussion. What is the kind of action on the ground that you're viewing? And do you think this momentum is sustainable?
So look, there are two parts to this. I completely agree with Salil to say that the last month has been very different from the scene, let's say, from November of last year. So from November of last year, there was a very discernible change in the markets in that companies that were earlier thinking of IPO plans had to either defer or shelve their IPO plans just because the market was not supportive. The last month has seen market activity. I also agree with you. At the top of the show, you made the comment to say a lot of secondaries have happened, particularly on stocks that were coming out of their lock-ins and so on and so forth. Quality names have come in. So that part, I definitely see as positive. Will I interpret this to say, though, that primary market is back? It depends on how you define it. Quality assets at reasonable valuations, certainly primary market is back. However, in a scenario where money is not going to be globally as easy as it was, let's say, during the COVID times when really the monetary policies meant that money flow was very easy, I do think that the scope of the equity market window will be more calibrated. Investors will be more careful, and the kind of assets that will be able to access the primary markets, at least, they will need to show, let's say, a higher threshold than we were seeing in let's say, the last 2 years. So okay. I'm optimistic, though cautiously so.
All right. So one point I'll make is that a lot of deals had gone out of the market also because of the froth and the impending headwinds on the macro side. So Salil, valuations have a big role to play in deal making, and you can reflect and throw more light on that particular bit. Some froth was out of the market. Now we are again seeing enough volatility. Instead of saying euphoria, I would say call it volatility because it is still tentative on a day-to-day basis. How do you put together all these factors fitting in for the future trend of deal flow?
So let's put it this way. From the valuations point of view, the world has changed, and therefore, price points and market multiples have changed. What they were, let's say, 12 months down the behind us versus now are different. The sectors which could be of interest also change a little bit in this. You mentioned about froth. Yeah, I think there was a concern that a lot of, especially tech related areas wherein, valuations seem to be pretty large at that point of time. They were then reflective of what global markets were looking at, especially NASDAQ and the likes. There's been serious correction out there, so that correction is not lost on India too. And, for, some of the tech related companies, that correction is reflected in traded prices today, as well as increased interest, if at all. The type of interest has changed. Let's say in tech side, what we do perceive now is a lot more focus on, even within the tech, the quality names with either profitability or a decent path to profitability. Those are of sure interest. Among the other sectors, there's a whole set of sectors which have also started becoming, important beneficiaries in the marketplace today. And the whole manufacturing related area is of tremendous interest. And there people are willing to pay strong price points because they see that the runway for growth is very good. So I would think, valuations, the froth on tech reduced, a lot of discerning stuff.
Yes.
But I think the interest is, it goes into stuff like manufacturing, a lot of financials, electronic design, chemicals, those are the areas which are seeing good quality interest now.
All right. So those are the sectors which are more in vogue right now. Now, Vivek, Salil mentioned about the startup IPOs and the valuations and the deal making there. Do you think that the equity markets in this tentative phase is going to give another chance to startup IPOs at all, even if valuations have come down? And in the promoter founder mindset, have the valuations really dipped now?
Okay, so 2 points to make. A, I think access to globally as interest rates harden, access of the equity markets to more pools of capital goes down because capital flows into other asset classes. So that is one thing to bear in mind. Two, that having been said, I wouldn't call it so much the startup versus the non-startup community. I would simply say the bar for proving yourself to be a worthy candidate on the exchange has gone up. In other words, earlier the market was willing to see you as a good story, path to profitability of 5 years, 7 years, 6 years, 4 years. We've heard all kinds of stories. And so long as you had a large share of the market, that was acceptable. I do think that the market has fundamentally altered, and the current market will now perhaps not believe so much. They will want to see a shorter term, or at least a medium term path to profitability as a very inherent factor before according a chance to what you call a startup for an IPO.
Right.
So the traditional sectors, of course, but in the new age sectors, a sounder business model as demonstrated by an immediate path to profitability or a closer path to profitability, I think will be the definition of what the market is willing to accept.
Right. Path to profitability is something that we have been harping on again and again. And in the equity market euphoria that we saw last year, same time, Salil, a lot of things got passed very easily. But now the investors have also learned their lessons. The founders have also understood the public market to some extent. Another important event and milestone in the life cycle of some of these startups and unicorns which made it to the IPO market are the lock-ins getting over. We saw the entire case pan out with Zomato. From that experience and looking into Policy Bazaar as well as Paytm coming up in the next 2 months, what is your view on the acceptance and how it will go through, and in terms of investor mindset and acceptability at these rates?
So I agree with you, Nisha, that, the opening up of the lock-in, the statutory lock-in, is an event which is an important event. And, companies need to, prepare for that. It's not just in a lot of such companies, shareholders are a fairly diverse set of shareholders. They could be different private equity shareholders with different investment time horizons themselves. So each one may potentially have a different way of looking at it, different entry price points and so on. So it becomes trickier. Having said that, we've also seen that the markets have, in some of these companies which have had stock coming out of lock-in, taken the lock-in stocks in their stride. We had Sona Comstar coming out, certain blocks happened in that. Even at a much larger name, somebody like an HDFC Life, where, Standard Life is a large shareholder. They have, consistently sold blocks. It's just that the interest in the name and the price point will matter. It's not just to do with the fact that, I have a date on which lock-in opens up, and therefore there has to be immense selling pressure. The holders themselves, which is typically institutional holders, including private equity, themselves are also aware that, any lock-ins, any such blocks need to be nicely placed, which means that, some amount of, discovery on potential buyers has to happen. And therefore the stock gets placed in a calibrated manner rather than, it just gets sold on the screen. Sold on the screen is where destruction happens. If it's a calibrated buying, which is, organized, the markets take it in its stride. However, as I said, it will vary case to case. It will completely be dependent on, how incoming investors see that specific opportunity. And there are enough cases wherein if the opportunities seem to be pretty good, the stocks have been resilient, even though the lock-in stock has come into the market.
Welcome back. You're watching Big Deal, and we are discussing the equity market deal flow. Now, Vivek, we have really looked at REITs and InvITs as an instrument, and an important aspect of the equity markets also since the inception. It has evolved. And do you think that in the interest hardening scenario, with its combination of both being fixed and equity component in terms of returns to the investors, that is going to be much more emphatic and play a larger role in the system and for investments? Do you see that already picking up?
Look, in the context of the Indian market, I think REITs and InvITs is something that is just meaningfully starting out. Just the fact that we have so much of a gap in terms of accessing REIT InvIT capital for a country which has a lot of REITable, InvITable assets, if I can call them that, means that I think there will be a huge window of opportunity for REITs and InvITs going forward. Bear in mind, it is a slightly different class of capital, as you very rightly stated, which can flow into REITs and InvITs. You have sovereign funds, you have more patient capital, you have more annuity returns type capital, which happily flows into these instruments. The government has been very proactive, I must say, in terms of devising a regulatory regime. And after having devised the regulatory regime, refining it constantly based on market feedback. And I therefore feel that REITs and InvITs is something that will very, very meaningfully pick up in the context of the Indian market in the short term itself. So yes, I'm very optimistic, much more optimistic on the REITs and InvITs window as things pan out in the short term.
Right. And Vivek, even tax experts like yourself have worked enough with the government to make it a more acceptable instrument. So Salil, the tax benefits have really gone to the public REITs and InvITs as well as the private ones as well. Where are you seeing most amount of traction? What kind of investors, and what is the on-ground pipeline looking like?
So Nisha, we are really enthused about both these products.
Yes.
They're relatively, as Vivek said, relatively new to the Indian markets, but I think the regulators have done a fantastic job to, allow us to get them to the markets in a nice manner. The first set of InvITs found the going difficult because, people probably did not be sure where to keep these assets as, whether they're, in which books, the equity books, the debt books or the balance books and so on. But I think people have, found their own calling around it. The number of investor interest that we've seen in InvITs has just gone through the roof. People are interested both in listed, public listed and private listed too. Even in the private listed category, we see a lot of, HNI as well as, the AIF kind of interest coming in, apart from the, the large people who are wanting to take positions. REITs is a classic category which, gives you yield, but also gives you upside and capital appreciation coming out of, the underlying properties going up. Indians inherently play for capital appreciation in the real estate market in a massive manner. So, so the REITs have given them the benefit of both an yield plus a cap upside. So I think both these categories are seeing both institutional interest, within which, institutional private as well as institutional public market. And I would say the high net worth or the retail HNI category, which is, the large ticket investors who are willing to take positions in this. There's a lot to happen, as Vivek nicely put it across. There are enough rateable or inevitable asset categories which are there in the markets in India today. We've just seen, tip of the iceberg, the easy ones, the transmission-based ones, as well as, the commercial office space-based REITs. Those are the starting point ones. And there are quite a few more who may want to tap into this. And, there will be different categories within this also that will come up, the warehouses and the likes, but also, by their inherent nature, either inevitable or REITable assets that will come up. We would expect a lot of action on both of these.
All right. So a lot of action really expected in REITs and InvIT side. And it is a very, unique proposition in terms of the capital intensive sectors also raising capital at a cheaper cost. So definitely an important aspect. But Vivek, I want to understand that where is the momentum according to you? Which sectors are you spending more time on, and which kind of products are you spending time on, and which factors will define whether or not deal flow is going to continue with the momentum it's seeing in the equity markets?
So now on equity markets or within REITs and InvITs?
No, equity market at large.
Look, I think equity market at large, Salil covered the sectors very nicely. I would say only one thing. If companies are fundamentally strong and they have, let's say, a more visible business model, those companies are the companies that will be welcomed by the primary markets. If companies have a slightly longer term pathway to more visibility in their business model or to more visibility towards profitable cash flows, then I think those sectors will struggle. So technology, tech services, for example, pharma, these sectors are, or all the traditional sectors, these sectors I think will continue to be strong. So strong players in the sector will find it relatively easy to hit the primary markets. BFSI should see a fair bit of activity. We've seen some control deals happening already in the private equity space. I think time is right when some of those candidates will then come up for listing on the public markets.
Right.
So from a public market standpoint, I think it's less about sectors, more about the kind of company and the attributes of the company that is going to be able to be successful on the primary markets.
Right. And Salil, even finance minister of the country has made a point that capital markets should be used more for growth capital. Now, so far, the blocks are of the nature of private equity getting a window of opportunity at decent valuations to exit from their holdings. How do you see this momentum in terms of fundraising for growth capital by the companies?
I think blocks obviously are secondary market, so they will be monetization for somebody and an entry for someone else. That's the nature of blocks. But we do see a capital raise, which is fresh capital for growth, coming in the form of both QIPs as well as in the form of IPOs. And there will be obviously certain sectors which will be able to absorb this better. Our sense is the whole manufacturing space in India, which is, the government initiatives, PLI, and others, ensure that this is a sector, these manufacturing sectors generally are of serious interest and can take amount of capital infusion too. The companies in the electronic design and manufacturing space, people who are into the defense spaces, even, companies into the chemical spaces who are having expansion plans and so on, general capital goods in general. So, those are areas wherein primary markets could be used and will be used as a vehicle for raising some amount of capital. We're also seeing the amount of onus that the government has put on infrastructure means that there is, and we've seen this, seen the amount of stuff that has happened on the roadside and so on and so forth, means that companies in the infra space, some of them would also need to raise capital. And, we would think that will also go towards some of the capital formation that is there. So I think these are where capital gets built out of the public platforms. We should also not forget, Nisha, that some of the onus of funding growth also has been taken by private equity in the past.
Yes.
The risks of growth and capital formation has been taken by PE in the past. And it's nothing to frown upon to say that if some of them now use this window as an opportunity to monetize. It's the risk is being taken by private equity. Now it's well built, and now it is distributed to public.
So point well taken, Salil, that of course, if they don't make those exits and don't get the returns, then why will they invest? So proof of that investment is in the returns. But I want to ask you one thing, which is a very significant factor to note, is that is private equity looking at investing at these levels?
So you differentiate, Nisha, between private equity investing in markets and outside. Today, and it's still just about a month's data point, so it'll be very difficult to, draw full inferences out of it. Right now, the month's data point, you would see blocks which are a sell side from private equity, but buy side from a larger, broader spectrum of market participants, whether it is long only foreign funds as well as domestic funds.
Right.
The private equities run their private equity business too, right? Which is wherein they've raised capital, which is growth capital, which is getting deployed. New opportunity. And that investment is happening.
So Salil, running completely out of time, point taken, but that will be one factor that I'll be judging the market when the valuations for, because small ticket investments by financial institutions when sold by private equity is a very small commitment of capital to that particular asset, while private equity takes much more risk with a higher ticket size. And if they come and invest at these levels, that is a real show of these valuations sustaining. But thank you so much, both Vivek as well as Salil, for giving us so many highlights. REITs and InvITs are going to be in action, and some of the ECM deals and IPO window to some extent has opened, not so much probably for the startup industry. With that, it's a wrap. Thanks so much for tuning in.